Originally established in 1952, Southern Copper Corporation has evolved into a cornerstone of the global mining industry, characterized by its majority ownership by Grupo México S.A.B. which maintains an 88.9% equity stake as of late 2025. This high degree of ownership concentration is a defining feature of the corporate architecture, creating a structure where the public float of approximately 11.1% is traded on both the New York Stock Exchange and the Lima Stock Exchange. The organization is strategically bifurcated into two primary operating subsidiaries. Minera Mexico accounts for 63% of consolidated EBITDA, with primary assets including the Buenavista and La Caridad mines. Southern Peru contributes 37% of consolidated EBITDA, operating the Toquepala and Cuajone mine complexes and the Ilo smelter and refinery. This geographic and operational split provides a diversified base for asset management, although it also exposes the firm to dual regulatory environments. The current structure is the result of a significant merger in 2005, where Southern Peru Copper Corporation acquired Minera Mexico in a stock-for-stock transaction. This merger was not without controversy. It became the subject of extensive derivative litigation in the Delaware Court of Chancery, where the court eventually awarded $1.263 billion in damages to minority stockholders due to concerns regarding the entire fairness of the transaction price and process orchestrated by Grupo México. These agreements stipulate that Grupo México retains absolute control over the board and strategic direction as long as it maintains at least 35% ownership of the outstanding common shares. The conversion of Class A shares into common stock is also tied to these ownership thresholds, ensuring a stable, albeit highly concentrated, governance model that prioritizes long-term project development over short-term market fluctuations.
The investment thesis for Southern Copper is anchored in its position as one of the world's lowest-cost copper producers. For the fiscal year 2024, the corporation reported an operating cash cost per pound of copper, net of byproduct revenue credits, of 0.89 cents. This represented a 13.9% reduction from the $1.03 reported in 2023. By the third quarter of 2025, this cost efficiency had improved further to a record 42 cents per pound, positioning SCCO at the bottom of the industry cost curve. Byproduct credits and revenue streams. The mechanism enabling this industry low-cost structure is the substantial revenue generated from molybdenum, zinc, and silver. These byproducts serve as a synthetic hedge, effectively subsidizing the cost of copper extraction. In 2024, byproduct production volumes increased across the board, with molybdenum rising 8.1%, zinc surging 98.5% due to the ramp-up of the Buenavista concentrator, and silver increasing by 14%.
The 2025 production and target metrics highlight the shifting product mix. Copper. 2024 production was 973,851 tons, with a 2025 target of 960,000 tons, a 1.4% decrease, primarily due to lower grades. Molybdenum. 2024 production was 28,997 tons, with a 2025 target of 30,000 tons, reflecting a 3.5% year-over-year increase. Zinc. 2025 production is targeted at 174,700 tons, a 35.1% increase over 2024 estimates, driven by the Buenavista concentrator reaching full capacity. Silver. 2024 production was 20.7 million ounces, with a 2025 target of 23.0 million ounces, showing an 11.1% upward trend. In the third quarter of 2025, total byproduct credits reached $1.81 per pound of copper, compared to $1.48 in the previous quarter. This surge was primarily driven by higher sales volumes and market prices for silver and molybdenum. Silver represented 7% of the quarterly sales value, with prices averaging $39.56 per ounce, while molybdenum contributed 13% of the sales value, with prices averaging $24.30 per pound. Asset-level efficiency and metallurgical integration. The corporation operates four major open-pit mines, Toquepala and Cuajone in Peru, and Buenavista and La Caridad in Mexico. The integration of these mines with proprietary smelting and refining facilities, such as the Ilo smelter and refinery in Peru, allows for the capture of margins that would otherwise be lost to third-party treatment and refining charges, TC/RCs. In 2024, the reduction in cash costs was partially attributed to a 4-cent decrease in production costs and a unit cost effect generated by increased volumes.
However, the 2025 production cycle has faced headwinds from declining ore grades. Copper production in the first 9 months of 2025 fell by approximately 2.8% to 714,098 tons, primarily due to lower grades at both Mexican and Peruvian operations. Despite this, the company's ability to maximize zinc production at the Buenavista concentrator, which is currently operating at full capacity, has provided a vital offset to lower copper volumes.
Comprehensive Financial Performance Review, 2024-2025. The financial trajectory of Southern Copper has been characterized by record-breaking sales and profitability, driven by a combination of favorable metal pricing and strict cost containment. For the full year 2024, net sales reached an all-time high of $11,433.4 million, representing a 15.5% increase over 2023. Net income for 2024 was $3,376.8 million, a 39.2% improvement year-over-year, with a net income margin expanding to 29.5% from 24.5%.
Analysis of 2025 quarterly trajectory. The momentum continued into 2025 with several record metrics in the third quarter. Net sales reached a record $3,377.3 million in Q3 2025, a 15.2% increase from Q3 2024. Net income rose 23.5% to $1,107.6 million in Q3 2025, compared to $896.7 million in the prior year's quarter. Net income margin expanded from 30.6% in Q3 2024 to 32.8% in Q3 2025. Earnings per share increased 20.5% to $1.35 in Q3 2025, up from $1.12 in Q3 2024. For the first 9 months of 2025, net income reached $3,027.0 million, representing a 17.2% increase over the same period in 2024. The corporation's cash position remains robust, ending the third quarter of 2025 with $4.5 billion in cash and cash equivalents, providing a significant war chest for its capital expansion program.
Cash flow and capital allocation. The efficiency with which Southern Copper converts revenue into cash is a critical metric for valuation. In the first 9 months of 2025, cash flow from operating activities was $3,258 million, an 8.4% increase over the $3,061 million posted in the prior year period. The allocation of this cash is strictly prioritized between capital investments and shareholder returns. Capital expenditures for the first 9 months of 2025 totaled $902.7 million, representing 29.8% of net income. This reinvestment rate is essential to sustain the corporation's long-term production targets. The $15 billion capital expansion pipeline. Southern Copper is currently engaged in an ambitious capital investment program with a total commitment of $15 billion over the next decade. The primary objective is to increase annual copper production to 1.6 million tons by 2035, which would involve a 5% compounded annual growth rate, CAGR, from 2024 levels.
The Peruvian growth engine. Approximately $10.3 billion of the total capital program is earmarked for Peruvian projects. Key developments include Tia Maria, copper, targeted for 120,000 tons per year. Operations are expected to start in 2027, with a total investment of $1.8 billion. After years of social delays, the project received its final exploitation authorization in October 2025. Los Chancas, copper, slated to add 130,000 tons of copper and 7,500 tons of molybdenum annually, with a projected start in 2031 and a $2.6 billion investment. Michiquile, copper, expected to produce 225,000 tons annually starting in 2032, supported by a mine life of more than 25 years. Ilo smelter expansion, a $1.3 billion investment to upgrade processing capacity, ensuring downstream processing aligns with mining production.
Mexican capacity expansions. In Mexico, the investment strategy focuses on El Pilar, copper, targeted to contribute 36,000 tons of copper annually starting in 2028. El Arco, copper, a world-class deposit in Baja California expected to become operational in 2030, contributing approximately 190,000 tons of copper and 28,000 tons of SXEW production.
Quantitative valuation and multi-model perspective. The valuation of Southern Copper requires a blend of relative multiples, discounted cash flow modeling, and net asset value assessments. As of early January 2026, the equity is trading at significant premiums relative to its historical averages and peer group.
Relative valuation analysis. Southern Copper has historically commanded a premium multiple in the mining sector due to its superior margins. Its current relative valuation metrics show significant divergence from averages. P/E ratio LTM, Southern Copper trades at 33.52x compared to a peer average of 26.4x, an industry average of 27.2x, and a 10-year average of 25.24x. EV/EBITDA LTM currently at 18.7x compared to an industry average of 8.5x and its own 10-year average of 11.9x. PS ratio FWD standing at 8.67x, nearly double the peer average of 4.48x. Return on equity standing at 38.7% compared to a peer average of 14.2% and an industry average of 12.8%. This suggests that investors are willing to pay a premium for SCCO's ability to convert revenue into record net income and high adjusted EBITDA margins, which reached 59% in Q3 2025.
Discounted cash flow modeling. A standard DCF valuation for Southern Copper accounts for high capital intensity and commodity volatility. The WACC is estimated at 9.3% with a debt-to-equity ratio of 0.64. Intrinsic value scenarios based on current projections include alpha spread base case, estimated intrinsic value of $87.26 per share, implying a 45% overvaluation. Simply Wall Street DCF model estimates a fair value of $125.91 per share, using projected free cash flow rising to $7.14 billion by 2035. The current market price of the stock implies that the market is discounting a much higher terminal growth rate or a sustained long-term metal price environment that exceeds conservative analyst models.
Net asset value and asset sensitivity. NAV calculations for mining companies often hinge on pure play status. Southern Copper is viewed as a proxy for copper exposure, with 85% of revenue dependent on the metal. JP Morgan recently upgraded the stock to neutral, raising the target price to $92.50 by integrating the Tia Maria project into estimates. This project alone is expected to generate $17.5 billion in export value and $3.4 billion in taxes over its first 20 years. Shareholder returns, dividend policy, and sustainability. Southern Copper maintains a dividend policy as a key component of total shareholder return. The board consistently authorizes both cash and stock dividends. Dividend structure and yield. Recent history shows the following trends. 2023, annual dividend estimated at $3.60, providing a yield of 5.45% and a 60.3% payout ratio. 2024, estimated $3.60 annual dividend with a yield of 2.75% and a 67.0% payout ratio. 2025, current annualized cash dividend is $3.60, yielding 2.42% with a 75.47% payout ratio.
Dividend safety and FCF coverage. The safety of the dividend is supported by the company's low-cost profile. The operating cash cost of 42 cents per pound ensures profitability even in lower price environments. Cash flow coverage of the dividend remains stable, with 84% of cash flow retained after payouts as of late 2025. Legal, regulatory, and tax frameworks, Mexico and Peru. Operating in Latin America exposes Southern Copper to evolving regulatory and tax risks. Mexico's regulatory shift, the new mining law. Enacted in May 2023 and upheld by the Supreme Court in 2025, reforms represent a shift towards state dominance. Term reductions. Concession terms were cut from 50 years to 30 years, with one 25-year renewal option. Public bidding. New concessions are granted only through public bidding, eliminating the first applicant advantage. State exploration monopoly. The Mexican Geological Service, SGM, now has exclusive exploration rights. Taxation and comparative burden. Mexico is one of the costliest jurisdictions in Latin America for mining. Effective tax burdens, including income tax and special duties, range from 52% to 55%.
This is significantly higher than rates in Peru, 47%, and Chile, 41%, which may incentivize SCCO to prioritize capital allocation toward its Peruvian pipeline. Peru, social and political factors. The approval of Tia Maria is a milestone, but social risks persist. Approximately 31% of Peru's untapped capacity is considered off-market due to social challenges. Southern Copper mitigates this through framework agreements, such as the 2025 agreement with the Tiaparo community for the Los Chancas project.
Analyst Consensus and Forward Outlook 2026-2027. Wall Street maintains a neutral to reduce consensus, reflecting concerns that the stock is valued richly relative to targets. 2026 forecast, EPS expected to reach $6.19, up 17.3% year-on-year on revenues of $14.49 billion. 2027 forecast, EPS projected at $5.44 on revenues of $13.57 billion. Conclusion. Southern Copper presents a dual-faced investment proposition. Operationally, it has a cost advantage and the largest reserves of any listed firm. Catalysts like the Tia Maria authorization and the Buenavista ramp-up provide long-term growth. However, the current PE of 34x and EV to EBITDA of 19x represent significant premiums that require flawless execution across its $15 billion pipeline. Regulatory shifts in Mexico and high tax rates in primary operating regions create potential ceilings for future expansion. While Southern Copper remains a high-quality proxy for copper exposure, the stock currently has a high valuation.